Imagine a bustling marketplace filled with buyers and sellers, each with their own unique approach to making a profit. Among these are two distinct types of market participants, the traders and the investors. Now, you might be wondering, what differentiates the two? Well, in simple terms, traders are akin to sprinters in the financial race. They buy and sell financial instruments within short time frames, often within a single day, aiming to make quick profits from the small price fluctuations. On the other hand, investors are more like marathon runners who purchase assets with the intention of holding them for a longer period. They're not swayed by the daily ups and downs of the market. Instead, they place their bets on the long-term potential of their investments, hoping that they will steadily increase in value over time. So, at a fundamental level, the difference between traders and investors lies in their approach to making money in the financial markets. Let's dive into the story of two characters, Rahul, a trader, and Ravi, an investor. Rahul, our trader, lives in the pulsating heart of the market. His day is a whirlwind of constant monitoring, buying and selling stocks like a seasoned haggler in a bustling marketplace. His eyes are glued to the screen, tracking the ebb and flow of the market trends. He's always on his toes, ready to make a quick decision at the drop of a hat. A slight change in the market. He's there, buying or selling, his fingers dancing over the keys. He thrives in the adrenaline rush, the thrill of the chase, the quick profits. But this game isn't for the faint-hearted. The higher the risk, the higher the potential for reward and loss. Rahul, the trader, is willing to ride these waves of uncertainty, banking on his sharp instincts and market knowledge to steer him through. On the flip side, we have Ravi, our investor. His approach is vastly different. He doesn't chase the quick profits. Instead, he's playing the long game. He spends his time buried in research, poring over company profiles, studying industry trends, and analyzing financial statements. His decisions are not made on the spur of the moment, but after careful consideration and thorough analysis. Ravi, the investor, is in it for the long haul. He's not swayed by the daily fluctuations of the market. His focus is on the bigger picture, the long-term growth prospects. He's willing to ride out the short-term market volatility in anticipation of long-term gains. His strategy involves lower risk, but it requires patience and a strong understanding of the market dynamics. So, you see, Rahul and Ravi represent two distinct strategies in the world of market players. Rahul, the fast-paced trader, thriving on quick decisions and higher risk, and Ravi, the measured investor, playing the long game with patience and lower risk. While Rahul's day is filled with quick decisions and fast-paced action, Ravi takes a more measured approach, playing the long game. Now that you've seen the differences between a trader and an investor, it's time to reflect. Consider your financial strategy as a mirror. What does it reflect about you? Are your choices in sync with your risk tolerance? Are you comfortable with the possibility of losses, or does the thought keep you up at night? Just like how a mirror doesn't lie, your financial strategy should be truthful to your time commitment. Are you able to devote hours each day to keep pace with the market's rapid movements, or would you rather set and forget your investments, checking in periodically? Finally, look at your reflection in the mirror of your financial goals. Are you seeking quick profits or building wealth for the long term? Reflecting upon these aspects can help you identify your financial persona. Are you more like Rahul, thriving on the thrill of the trade? Or do you identify more with Ravi's patient long-term strategy? Remember, there's no right or wrong choice between being a trader or an investor. They're simply different paths leading to the same destination, financial success. Let's take a moment to reiterate. Trading, with its short-term focus, offers the potential for quick profits, but it's also coupled with higher risk and demands more time and attention. Investing, on the other hand, is a long-term game, promising steady returns over time. It requires patience and a knack for recognizing valuable assets, but it's generally less stressful than trading. Your choice between these two paths will depend on your personal preferences, your financial goals, and your tolerance for risk. Are you a thrill seeker, hungry for rapid gains? Or perhaps you're more of a strategic thinker, willing to wait for your investments to bear fruit. So, whether you're a Rahul or a Ravi, the most important thing is to understand your financial strategy and make informed decisions.